For the avoidance of doubt, the Simple Side does not provide investment, tax, or legal advice. As with any asset, the value of any asset class can go up or down, and there can be substantial risk that you lose your money buying, selling, holding, or investing in any asset. You should carefully consider whether trading or holding assets is suitable for you in light of your financial condition.
This week, portfolio returns were brought to you by AI money getting spent, weight loss drug land grabs, and a will they, won't they Fed. Portfolios were up 5.47%, 2.59%, and 0.26% on the week. Let's talk about it.
Welcome to the simple side. Market beating picks inside. There's no jargon and no time to waste. Join the simple side and end up in first place.
All right, welcome back, or if it is your first time on the podcast, welcome to the Simple Sides Saturday Sendout. Like I mentioned in that quick opening, the portfolios this week all ended up and they looked great, of course, compared to the S&P returns that we saw there. I think the S&P this week returned 0.29%, so 2 out of the 3 portfolios were outperforming. And overall, over the past month or so that these have been on autopilot, they have been outperforming as well. So very, very, very happy with the performance there. As a quick reminder, our disclosure is in the email footer. You can go and copy trade our portfolios on autopilot. There are links in the newsletter at thesimpleside.substack.com to go and copy trade there. You can find the podcast on YouTube, Spotify, Apple Music, and on Substack. And you can get daily market news from the Simple Side Daily. So if you're wanting to keep yourself up to date with everything that's happening, go and follow the Simple Side Daily and get all of your news there. If you want to go paid and support that channel, it's $1 a month. It's not going to give you great stock deep dives. It's just going to keep you updated on the market. But some people want that stuff. As a reminder, I recently added some cool things into our paid subscriber spreadsheet. And for those of you that don't know what that is, the paying subscribers to this newsletter have access to a spreadsheet that show all of my portfolios, the holdings that are in each of them, and then interesting trades and things that I am making or thinking about making. And I just recently added a tracker to show positions that are overextended or oversold in my portfolio. So you can think about DCAing into some of those or buying into some of those if you're looking for some places to park your money. As of right now, in our flagship fund, we have 3 stocks that are outperforming. Napco Security up 44%, Google up 41%, and Arista Networks up 21%. In our AI secondhand effects portfolio, we have LEU, which I think is Centrus Energy, up 309%. Bloom Energy, ticker BE, up 189%, and ticker FLR up 76%. In our in our tech growth portfolio, we've got Oklo up 82%, Zeta up 43%, and SoFi up 33%. I like all these positions. I'm probably not going to be trimming any of these, but those are the top 3 positions in each of those portfolios. Of course, we've got a bottom 3 list as well. The lowest percent return for our flagship fund is FTNT Fortinet with negative 16%. In the AI secondhand effects portfolio, we've got Equinox down 19%. And then in our tech growth portfolio, we have Shift4 Payments down around 10%. Before we get into everything, a reminder to leave me your comments, your thoughts, things that you want to see, things that you don't like about the newsletter by clicking this button that says leave me your thoughts in the newsletter. Again, thesimpleside.substack.com. All right, like I said, the portfolios performed great this week. Our tech-focused growth was up 5.47%. The AI secondhand effects portfolio was up 2.59%, and the flagship fund was up 0.26%, which just underperformed the S&P 500 at 0.29% returns. All of this is according to autopilot data. So if you want to get updated on the returns, again, go check all that stuff out on autopilot. There are links all over spread throughout the newsletter, so you can go and find all those just by reading through that. All right, let's talk about some news. What happened this past week? Well, early in the week, we saw big tech ride fresh highs on AI headlines. Micron's record outlook, Nvidia teaming closer with OpenAI, and the Apple iPhone 17 demand buzz. Midweek, we saw rate cut odds somewhat wobble after firm economic prints. And by Friday, the tape steadied but finished a touch lower. The S&P 500 down 0.3%. Week to date, the Dow down 0.2%, the Nasdaq down 0.7%. And if you lifted up the hood, breadth was mixed. Energy caught a bid on firmer crude, while megacaps took turns giving back gains. Interestingly enough, talking about the rate cuts, if you took a look at the odds in Polymarket, it seems that the 25 basis point October rate cut is still in full force with an 81% chance, down from 5% earlier in the week. The closest competitor, of course, is no change with odds under 20%. So it still looks like we're going to get that 25 basis point cut in October. But for some reason, the market decided to take a bit of a dip this week on odds decreasing from 86% earlier in the week. I am calling this a nothing burger downswing. Thanks to NYU grad for the nothing burger terminology that he likes to throw around. It's not going to be a big deal. Unless the Fed comes out and specifically states that they're not looking at dropping rates, then some of the sell-off might be warranted. But even then, the sell-off is just overdone, not warranted right now. This past week, we did see a lot of big stuff happen, though. Pfizer is trying to champion the weight loss arms race. They are looking to buy Metsera for about $7.3 billion in cash. Of course, this matters because GLP-1 obesity drugs are the fastest growing profit pool in pharma. Pfizer exited its prior obesity pill and is looking to buy a seat back at the table. I think this is really bullish news, actually, for companies like Eli Lilly, who have kind of I guess you could call it mainstream, the most well-known brand of weight loss pills. And so seeing other companies try to get in on the race is definitely attractive for companies like Novo Nordisk and Eli Lilly. Micron, of course, is blowing up with the tight chips, tight prices. Basically what happened here is that they were guided to a record Q1 fiscal year 2026 revenue of $12.5 billion on extremely AI-hungry demand. Of course, this matters because when memory starts to get tight, pricing power returns. Of course, that meaning these AI models not only need a lot of computing power, but they need a lot of storage space. If you can't keep the data somewhere and keep track about whether what you're doing is right or wrong, you're going to end up with models that don't make any sense. And so as these models continue to grow, the storage space is going to just explode. And that's what we're seeing here with Micron. You'll notice the same trend with companies like Western Digital, Seagate Technologies, NetApp. Basically, every single one of these companies that is selling these memory, these hardware memory drives, they're exploding. And I missed this. I can't believe that I missed this. What I did when I was building the AI secondhand effects portfolio, I focused more on energy, and I totally missed all of the hardware and storage side of things. So I'll take the blame on missing putting that in the portfolios, but we've still seen great performance, so it's fine for now. Other news. A lot of Nvidia news. Of course, they're working with Samsung right now for HBM parts, which I think is high bandwidth memory parts. And so, the faster that you can compute, the better your products. And so a lot of companies are going to be looking at using things of that nature, getting them integrated into their products, into their systems. We also, of course, saw Nvidia looking to buy more speed with a greater than a $900 million offer to get the entire Infabricas team and license its networking tech that stitches 100,000 plus GPUs into one logical system. So crazy stuff happening there, but more usable compute per dollar is basically what they're looking for, and that means better networking. So again, Nvidia is just all over the place on this stuff, and they're doing an incredible job of staying on top of everything. Of course, we also have the Oracle TikTok deal that is in the mix, Oracle being the kind of main buyer of the United States TikTok. And so we saw a big rally for them on that news, along with other news earlier in the week about their, future revenues just blowing up. And then, of course, Nvidia also making tighter ties with OpenAI, and they blew up on that news as well. So just crazy news on the OpenAI side of things, or on the Nvidia side of things. Again, here, just wildness. We also saw Alibaba shoot up, saying if AI capex is a race, spin faster. And so they're going to be spending above their prior $50 billion plan. And that should come as no surprise. I mean, the Chinese government just kind of cut out a lot of the US operations there. And so they're going to be looking at investing heavily in their companies to build out their own personal products and cut out the reliance on the US. So no surprise that happened. Again, I can't believe I missed that. I had been talking just last week or 2 weeks ago about putting some money into Alibaba, PDD, JD, stuff like that. And I never pulled the trigger on any of it. And darn, missed out a little bit. In other news, Berkshire exits BYD after 17 years. And it's not doom for EVs, but they made their money and it was time to leave. They bought in long before the hype happened. And as Buffett has always said, sell the good news, buy the bad news. And while EVs were getting crushed earlier, they bought in a big position. And now that they're all the rage, and all these companies with their self-driving are blowing up, they decided to exit and capitalize greatly, I'm sure. Bunch of other news for you to go read about, something about Eli Lilly, a bit about PayPal, Boeing, Accenture. So you can go and read about that again in the newsletter. And then, of course, I've got some 10-year treasury news, oil news, gold news, Bitcoin news, and you can go read about that as well. As always, we're tracking insider trade updates. This week, I think, marks the first week of our tracking where we're getting to look at the average monthly returns. And as of now, those average monthly returns are 14.02% on these insider trades. Just incredible returns. The best performing category are whale buys at 32.29% returns. And the lowest are buy the dip, only up 8.52%. Now, I should say that is 1 month. That is 1 month. I'm sure if I put out a poll and I said, what is the average S&P 500 return annually? You all would answer 8 to 12%, somewhere in that range. We're looking at insiders that over a month have made 8.52%. Whales, buys that have been over 10 million are up 32.29%. These are just ridiculous metrics, And it should come as no surprise. I mean, that's why we started to track all this stuff to show you guys. And of course, we've got a bunch of information in the newsletter about all the trades that just happened. AVRN, director buys 30,000 shares. Next, director buys 100,000 shares. BDSX, director buys 142,000 shares. Next, NRG, ticker NXXT, buys 1 million shares. So go and look at all that stuff. I mean, it's very, very interesting to go and look at. And in all honesty, it's just, it's valuable information. It's very, very valuable information. And we should be paying more attention to it than we are. And that kind of leads me into my interesting trade ideas. I actually have 4 tickers this week, which is uncommon. Typically, I talk about the same stocks week over week, just kind of updating you on some of the trades or bets that I made. In the past, I talked about UNH and Apple, and both those companies, those trade ideas just performed ridiculously well. UNH, of course, went from like $300 when I was recommending it up to like $350. Apple went from under $200 up to like $220, and I'm not sure what it's at now, but incredible returns. This week I'm talking about NTSK, NXXT, NEXT, and KVUE. I wrote up a little bit about each one of these companies in this section of the newsletter. Of course, Netscope is a new kind of competitor in the cloud security, cybersecurity world. And they're expected to grow at a 27% compounded annual growth rate, at least the revenue is, through 2027, which looks at the company being valued at something like $48 a share, which is like a 100% return over the next 2 to 3 years. And I want to see revenue and profit. I want to see profit grow out of this company before making an investment, but it's a very attractive company as of right now. Of course, the theses for Next NRG and Next Decade Corp. are both about insider buying. So you can go read about both of those. I'm not going to talk through it all now. And then, of course, we've got Kenvue, which is the maker of Tylenol, which, of course, I'm sure you've all seen has been getting crushed based on all of the news about Tylenol causing autism when taken by pregnant women, causing their children to have autism. Of course, the stock is down 21.55% on the news over the past 3 months. And believe it or not, Tylenol only makes up about 10% of the company's revenue. So a 20% drop in price to me is somewhat unsubstantiated. And interestingly, Kenvue has had the same claim made against it in 2023, and a judge ruled that the evidence was lacking. And I'm suspecting the same thing is going to happen again. I think there's some plays here to be made, buying a couple hundred shares and starting to just sell covered calls on all of that stuff, bring in a little bit extra income. Of course, you've got a 4% dividend that Kenvue pays, 4%, which is going to be huge for people that are able to put in a bunch of money there and then also sell covered calls. Just very interesting time for that company stock. But I think this is going to be something similar to UNH's drop. Who else has had big drops? I don't know. But I think the company is going to be coming back. Their revenue is very stable. Their profits are very stable. They're not really growing. They're pretty stagnant. But that 4% dividend is violently attractive if you're somebody who's looking to kind of set yourself up in the world of dividends. So go and check that out. Of course, if you want to continue to read about my total portfolio performance, you can do so. And I'm just going to hit on a couple of quick things there. We are now over $800,000 in assets under management, $830,000 to be exact. And that means that based on our returns in each of our portfolios, we've made investors over $100,000 so far in just a month. So we've created $100,000 for our subscribers in just a month, which is just incredible. The tech-focused growth portfolio is up 21.3% since we put it on autopilot. The AI secondhand effects portfolio up 17.89%, and the flagship fund up 5.28%. Again, you should be copy trading all of that stuff. If you're not copy trading all that, you're missing out greatly. You need to go jump on autopilot and start copy trading those portfolios. It's just ridiculous returns right now, and I'm very happy with the performance, as I'm sure everybody who's subscribed is as well. All right, everybody, I am going to leave it here for this week. I hope you all have a great rest of your week, a great rest of your weekend. You should be seeing some articles come out this week about a potential trade, or a trade that I'm probably going to make, and I will be seeing you all for another Saturday Sendout next weekend.